Ladies and gentlemen, and the cat from Connecticut, we welcome you to the pre-show. The actual show will start in 1 minute, and it'll be even worse than this. I am AJ Puppet, and Ed Gordon is going to be the master of ceremonies for this presentation. Ed, how are you?
A little soggy today, but good.
Oh, it's raining in New York, I heard.
6 out of 7 days.
Wow. Hey, Ed, I'm looking for a job. Working here for Alan is terrible. The working conditions are bad, and he doesn't really give me a break for lunch. Are you looking for anyone?
No, you seem a little bit stiff.
All right, let's get started here. Okay. Oh, what did I do? Hello? I lost my view. Let's see if I can find it. There we are. All right, welcome to today's presentation. It is Saturday, September 30, and I am here with Ed Gordon and Joey Kleiner, and we're going to talk about Ed's discussion of planning techniques. Last week, we concentrated on life insurance. We had a lot of really good input. It was actually 2 weeks ago. So today we're going to talk a little bit about life insurance, but then a lot about some other planning techniques. We accidentally sent you the slides twice. So the first slide deck and the second slide deck are exactly the same, but if you have two monitors, you could look at both of them at the same time. This is a CPA Academy presentation. And if you came in through CPA Academy, you just have to answer 3 of the 4 polling questions, and we'll let you know when that occurs. If you came in through our website, then you're going to get Florida Bar continuing credit if you ask us for it. Otherwise, the presentation is going to be very informative. If you have any questions, go to the upside down pyramid, click on it, ask your question. We'll make sure your questions get answered. And let me mention that October 11th, I'll be speaking for the National Association of Estate Planning Councils on designing and implementing estate planning structures with the IRS in mind. If you would like to attend that presentation, it's not free, but it should be half decent. You can click on that link there to sign up for it. And if there's anything in particular you would like for me to mention or to think about with respect to estate planning with the IRS in mind, and I sincerely hope the IRS will be opened on October 11th with what's going on right now on funding, then please let me know. Okay, polling question number 1, we'll get it out of the way. Edward Gordon, A, the founder of Preservation Capital Partners in New York. B, a supporter of the New York Holocaust Museum. C, a supporter of the Guide Dog Foundation. D, lives in Huntington Bay. E, is a certified estate planner. And F, all of the above. The best answer is F, all of the above, but if you answer anything, we will give you credit and welcome you to this presentation. Wesley, let me know when I can go. All right, very good. Well, Ed, do you want to lead off the discussion and then let us know when you want to turn the slides to Gratz?
No, you can lead off. Put in your card. I have to talk to a puppet once in a while. You could start off.
All right. There are a number of estate tax planning techniques and income tax planning techniques that are drastically underutilized. And the reason that they are drastically underutilized is because they are not well understood by clients who would make the decision as to whether to use them. And the reason that the clients do not understand them very well is usually because they've never even been discussed. Secondarily, another reason that clients don't understand the techniques very well is that the math can be a little bit complicated. And in my opinion, unless you see the math and understand the numbers, you can't really understand the technique. Now, the vast majority of the attendees today are financial advisors, mostly CPAs, a lot of tax lawyers, and financial advisors, but also a lot of clients and friends of mine who just want to know about these techniques. How's that, Ed?
That's great. I would say that we use a term in our office called Gerberize. We try to break things down to baby food. Somebody who's in the envelope manufacturing business doesn't understand what a total return swap is, or a credit derivative default swap, or a GRAT, or a grantor trust, or a complicated trust. And I think it's our job as advisors is to be able to impart the information to people so that they understand it, because when they understand it, I think they implement far more. I think when people are confused, they rightfully so don't put a pen to paper. And I find that if I can relay information to a client where they can regurgitate it back to me, they understand it. When they understand it, one, they implement it. Two, they become an advocate for our business because they give us a compliment in the form of, hey, this was really easy to understand. And I don't get those calls on the rare weekend that my client couldn't sleep at night and said, what did I do with that piece of real estate? How is that owned? Why can't I blank? And I think that a lot of professionals, we like using the acronyms, we like using the vernacular of what we know. And Alan will tell you that when we're down at in Orlando at the Heckling Tax Conference, and the conversations that happen in the hallway between lawyers and accountants and insurance professionals is all done in technical speak. And frankly, the reason why my wife doesn't go with me is because she just stands there and rolls her eyes the whole time and doesn't understand it. And that's a key to me, that if you do that in front of a client, they're going to roll their eyes and probably not continue doing business with us. So we try to Gerberize everything as much as we can. So that's kind of the goal of this conversation, is to take these concepts that people may know, the buzzwords, and get a little bit granular, but get granular by speaking it in a vernacular that is easily understood.
Super. So should we go to the first item on your slides, the grantor retained annuity trust?
Sure. So a GRAT falls under the category of split interest trusts. When we hear the term split interest trust, it's just that. There's two beneficiaries typically. In a GRAT, a donor or a grantor puts assets into the trust, and they take back the value of that asset plus a hurdle rate that was established the day they did it. And at the end of the term, whatever's left over belongs to the beneficiary. And if done correctly, the gift that was made of that excess after the grantor took back everything should be little to no gift tax consequences. Now you could dial that in. We've done GRATs where we didn't take back 100% of the asset plus the hurdle rate, and we did have a gift, but we did that was done purposely. So in a lot of these split interest trusts, we have the same equation. If I take an asset and I put it into this trust, and I take back the value of that asset plus the hurdle rate, and the asset grew at a faster rate than the hurdle rate, then all of that excess goes to the heirs, estate tax and gift tax free. So I'll give you an example. If I had an LLC that owned real estate that was valued at $10 million, and that asset threw off $1 million a year, and I put it into this trust, and I took back the $1 million a year for, let's say, 10 years, I've taken back 100% of the value of the asset. Well, the IRS says that there's a hurdle rate you have to beat, so maybe I have to make this a 13-year trust. So I take back $1 million a year for 13 years, and the IRS says that the present value of all of that income that I took back zeroes out the value of the gift that I'm giving to my children, because I, in essence, took it back. Now, if that asset exploded in value and became worth $25 million, the children receive all of that excess value without any gift tax consequences. Now, one of the issues with a GRAT is that it's difficult to make your grandchildren the beneficiaries of a GRAT. I think, Alan, you and I would call that an E-tip.
Right.
Versus a Q-tip or any other kind of tip. So this is a technique that's widely used. In the early 1990s, I ran around New York City with a lawyer named Dick Covey. At the time, in the early 90s, I was in my 20s. Nobody would take me seriously. Dick was a much older gentleman. And I will tell you that in the early 1990s, I had lawyers telling their clients that this was a very aggressive technique. It is not an aggressive technique. This is a technique that is widely used today. As a matter of fact, Dick Covey convinced the Walton family to do a type of GRAT that had no gift. And there's an example in the code that says you need to have a gift, and he says, no, you don't. And he convinced them to do this GRAT without a gift, and he beat the IRS in tax court, and they chose not to appeal. And we call those Walton GRATs. And for the practitioners out there that use software like Brentmark software, you'll see that you might have a choice on some of the software packages to elect a Walton GRAT versus a regular GRAT. Any other comments or experience with that, Alan?
Well, I'm going to show the numbers here.
Okay.
So what I did while you were talking was today's 75/20 rate, which is the hurdle rate, is 5%. And I assumed the grantor is 63 years old, which really isn't pertinent. And I did a 13-year GRAT. And I assumed that the payments will be level, annual payments. The beginning value here in year one, $10 million is the value of the building. I show the building growing at 7% a year. So that you see growth of 700,000. I show $1 million of rent income. And then the GRAT is going to pay the client $1,064,000 a year. And across the top, I see his life expectancy is 20 years. I'm going to illustrate 14 years. And the gift value, if I put $10 million worth of assets in a 13-year GRAT, the gift value, and it pays back it pays back $1,064,000 a year. The gift that I file on the gift tax return is $28.76.
Right. And if the asset grew in value, or you were able to discount the value going in, then you get the discount plus all of that growth gets shifted to the next generation. There's
Right.
two. The name of the lecture is The Good, the Bad, and the Ugly. The bad news is, if you die a day before this ends, it's as if you didn't do it. The entire corpus of the trust reverts back to the estate and is included in the estate at then market value. That is a perfect use for a put option. No different than if you had a large portfolio of assets in the market and you had a put option against if those assets fell in value. You could do the same thing here by simply buying a life insurance policy on the grantor. If the grantor dies, the Up until the last day of this transaction, the asset would revert back to the estate, and it wouldn't hurt to have a life insurance policy that would cover the risk of mortality. It is a perfect use, in your case, for a 13 or 14-year term policy that covers the risk of failure in the estate.
So basically, you would buy a 15 or a 20-year term policy, put it in an irrevocable life insurance trust. The policy amount, I guess, would be
Equal to 40% of whatever you think is the predicted value going back to the estate at the end of the term.
well, my expected is so when you look at this spreadsheet, you see at the end of, let's say, year 5, the property is worth 13 million. At the end of year 10, it's worth 19 million. At the end of year 13, it's worth 25 million. The estate tax savings are 10 million. So I guess you would, and that assumes only federal estate tax, not New York. So I guess you'd buy about a $15 million term policy, put it in a life trust. So this removes $25 million from this person's estate at 0 gift tax. Now, Ed, what happens if the IRS comes in and says, no, this building is really worth 15 million? It wasn't you. Then what happens? Have I made a $5 million gift?
Well, you could have, but you might want to have language in there that would say that the formula for the payout increases so that therefore it continues to zero out the GRAT.
Right.
However, if the IRS doesn't accept that valuation clause or that formula clause, yes, you would have then made a gift.
That's right.
Typically, GRATs don't get audited because there's really nothing for the IRS to get if you have that clause in there, as opposed to the sale of that asset to a grantor defective trust where you've made a sale. If you sold something for less than fair and adequate consideration, it's very possible that the service says that the difference was a gift. And that would be a harder argument to make versus a GRAT. There are also all sorts of variations of GRATs. People do 2-year rolling GRAT. So they put an asset into the GRAT, they take out 60% a year for 2 years, and therefore they get the excess that grew over that 2 years, and they just keep on, every time they take money out, they create a new GRAT, and they keep on going. We used to do that back in the late 90s with tech stock that was going public when we didn't know when it was going to go public. So we'd put $100 million worth of stock into the GRAT, take back 55 in those days, $55 million in year 1 and $55 million in year 2. And typically, if you didn't go public, you just took back everything. And then you just kept on redoing it over and over and over again until the company went public. And then you took back your 100 plus the hurdle rate, and all of the excess explosion from going public went to the heirs gift tax free. Just a little twist on the same.
Then just to cover a couple more mechanics, you see GRAT 1 across the top. I'm going to duplicate GRAT 1. I'm going to click on duplicate. Now I'm on GRAT 2, which is identical to GRAT 1, but I'm just going to say, what if this property is in an LLC, and what I transfer to the LLC is a 99% non-voting LLC interest. I transfer that to the GRAT, and I take a 15% valuation discount. It should be probably somewhere between 10 and 15%, just to be very, very conservative. Well, now the annual payments back to the client are $904,000 a year instead of $1,064,000 a year. So now at the end of the term, there's an extra $3 million in there. And let's say that the cash flow is a little better. Well, I'll call that GRAT number 2. Now we'll go to GRAT number 3, and maybe we'll extend the GRAT to 18 years. And now you see the annuity payments are much smaller, 727. And then you don't have to make annual equal payments with the GRAT. You could have the payments increase by 20% a year. So I'll click increasing by 20% a year. Now, look at this. The first year payment, I'm on GRAT 3 here. The first year payment is only $126,000. The next is only 152,000, then 182, and then it does go up. But boy, GRAT number 3, with increasing payment terms and a longer term, and I need to illustrate more years, I'm sorry, I didn't, is going to save twice as much. So setting up the GRAT is fantastic, but considering your alternatives is also important. Now, just for the sake of everybody watching this, I'm gonna, before we go to the next thing, I'm gonna make PowerPoint presentations for each of these 3 GRATs, hit submit. Now I've got these 3 PowerPoint presentations, and we'll circulate these after the talk. So Ed, anything else you want to mention about GRATs?
Yeah. One other downside of a GRAT, especially if you're using it for real estate, is that your heirs are inheriting these assets as a gift, and therefore the basis of these assets are that of the grantors. So in some respects, you're swapping out a potential estate tax for a future capital gain borne by the children or the heirs. If you died owning the asset, you get a full step up in basis currently. For real estate, that might be really important since real estate's basis goes down over time due to depreciation. And if you continue to borrow against the property, you may end up with a negative capital account where your capital gain could be tremendous. So there are some issues with deciding whether or not you want to make gift of assets through GRATs, or actually just pass away owning the asset and just insuring the estate tax against it so your children inherit them at a full step up in basis. And this is an analysis that most people don't do because they want to sell GRATs. They want to show that they're showing their clients that they're moving assets outside of the estate. Sometimes when you sit down and you take out a pencil and say, well, if I die owning these assets, I get to control them, which, believe it or not, a lot of egomaniacal, narcissistic, sociopath clients like. And my children inherit it with a full step up in basis and eradicate the negative basis on my real estate. And if you pencil it out, maybe it was just cheaper to buy a life insurance policy, even though people don't like doing that sometimes, to pay the estate tax. It might be cheaper in the long run than having your children continuously get involved in the 1031 exchange business while it still exists for real estate.
Right. I guess something else to mention is, of course, the client's going to pay all the income tax on the GRAT income, at least during the GRAT term, which is a really good thing. But sometimes the backfire I've seen, which is always interesting, is, wow, I'm worth 50 million and now my children are worth 150 million. What have we done? And the answer is, well, can you live comfortably on 50 million? Yes. Do you need the 150 million? No. Do you want to pay estate tax? No. Okay, well, you still indirectly control the 150 million because you control who the trustee is, and the trustee controls what happens. So, Ed, I want to do a quick polling question. So, a grantor retained annuity trust A receives a gift on day 1 and makes payments based on a percentage of the day 1 value for 2 or more years. B, what is left after the term of years will not be subject to estate tax. C, if the contribution is undervalued, then the payments back will be increased as opposed to there being a taxable gift. D, generally the remainder interest is not going to be generation skipping. E, all of the above, which is the best answer. And I'll mention that the one thing I would do before I would ever do a GRAT is consider an installment sale to a grantor trust, which I don't think we're going to cover today. When we do a grad, it's because the valuation, the potential gift is so large that we don't want the risk of paying gift tax that could occur with an installment sale to a grant or trust. So Ed, any comment on that or anything before we close the door on grats and go to charitable lead annuity trusts?
Nope.
So I had one question for you.
Okay.
We talked about the hurdle rate, and Alan, you mentioned that was the 75-20 rate. Is that a set rate, or does that change from time to time?
Ed?
Set in the month that you do it.
Okay. So once it's set up in the GRAT, it's going to stay the same during the whole GRAT term. But if you're doing that 2-year rolling GRAT you mentioned, you might have differences in those rates?
Yep. Absolutely.
And it's based on the 75-20 rate, which is generally 120% of the midterm applicable federal rate, which is generally what T-bills with 3 to 9 year terms are going for the month before, if I'm not mistaken, something like that. By the way, Joey,
yeah, it's like the 30-day moving average of the 30-day T-bill at 120%.
wow, you're amazing. By the way, Joey is a Stetson law student who's working for us on the Estate View software. Joey does have prior experience as a financial advisor, so it's great to have him.
Jacob DeGrom, wasn't he a pitcher at Stetson?
Was
I
he?
think so.
Oh.
One of the Mets
right,
pitchers were pitching. So a
What
charitable
about-
lead annuity trust, just like a GRAT. It's a trust that has two beneficiaries, a charitable beneficiary and a non-charitable beneficiary. In a GRAT, when you put an asset into the trust, the grantor gets back a payment every year for the term. Here, a charity gets a payment every year for the term. And the grantor gets a present value tax deduction of all of those payments that are going to be made to charity. The non-charitable beneficiary, called the remainder beneficiary, gets everything that's left over after the term of years and after the charity has taken out their piece every year. So for instance, if you put $1 million into a charitable lead annuity trust, and each year the charitable lead annuity trust paid out $100,000 a year to a donor advised fund, in essence, if your trust lasted for 12 or 13 years, you may zero out the CLAT, and anything that grew inside of the CLAT in excess of the payments that were made to charity go to the beneficiaries tax-free. In addition, I'll give you some examples. There's lots of variations of doing this. We've done this for clients and made their alma mater their beneficiary of the charitable piece. And even though today we put $1 million into the trust and we're going to get back, or the charity is going to get that $1 million over that period of time, plus the hurdle rate, and my children may end up with a large sum of assets because those assets may grow far faster than the amount being paid to charity. The charity may recognize you today as a $1 million donor. And when you do the math and you take your deduction that you get on your tax return for the amount that is going to charity, you may realize that your children are getting a far greater benefit from this transaction than the charity. And after the deduction is calculated, you realize that this costs you nothing to give money to charity because of the deduction involved. So therefore, you become a $1 million donor to your favorite college or university or synagogue or church. And your children really end up with all of the value in this transaction. the charity does get their money. We did this with a client in day one. The client did this with a university down in Florida. I won't mention which one, but the client now sits next to the provost at every single football game. Because when we told the charity that with the school, that we had a trust set up, that they were going to be the recipient of X dollars a year for the next 20 years, they took the present value of that, which is the amount that you're able to deduct. And that is the value of the gift that the client made to the school. So for donor credit, that client was a $10 million donor to the school. He takes pictures of himself on the field every year, sends it to us and says, this is your advertisement to do CLATs.
That's awesome.
It's a very good way of solving for the obligations that a lot of people have made that are unfunded during their life, to fund them with a CLAT so that the charity gets this payment every single year. And realistically, the way they're set up is that your children are going to benefit greatly if those assets outperform the payments to charity.
Now, is there a restriction on what type of assets you can put into either a CLAT or a GRAT?
Well, it's a grantor trust. So if there's any taxable events that happen, they flow through to the grantor on the grantor's tax return. There are rules called the jeopardizing investment rules that probably apply to CLATs as they apply to other types of charitable trusts. So you probably wouldn't want to put in something that is well, actually, there's an exception to that. If the donor puts in jeopardizing investments, that's okay, but the trustee can't invest in jeopardizing investments. So, your long, short, merger, arbitrage, event-driven, half gainer, full twist hedge fund that you think is going to make 200% a year may jeopardize the charity's interest in that trust. So you really want to stay with investments that are not so off the reservation as it has bad optics. But we've done this with pre-IPO stock. We've done this with business stock. We've done this. This is not a tax-exempt trust. It's not a charitable organization under 501c3. So any taxable events that happen inside go onto the tax return of the donor. And unlike other grantor trusts where the donor can be reimbursed for taxes paid, you cannot do that in a CLAT. You would violate the, I forgot the name of the rule is, but you would, in essence, be dipping into the charity for your own good, and you can't do that. So there is, like Alan had described before, you could have what we call the success trap, is where you can have an asset that performs really well in a very tax inefficient environment inside the CLAT. And I literally have had calls from clients, and especially in the later years on CLATs, where they said, I'm choking on paying these tax payments. So there are a million different ways to design a CLAT. You could backload them. You could make them for a lifetime. You could make them for a period of years. There's just a million different variations when you sit down to do this. But we've done, in New York especially, we had a lot of hedge fund managers that had offshore assets that they had to come back by a certain date, and they paid tax on them. So they had huge taxable income years. So we took a substantial amount of that and we donated it to a CLAT, and we were able to offset 30% of their adjusted gross income for the year that we did this. Anything over that we could use against their income for the next 5 years, no more than 30% of their adjusted gross. And we did CLATs. The largest one we did was a 9-figure CLAT. And what I like about CLATs is when you take the deduction on your tax return, you file with your tax return all of the relevant information of the CLAT, the trust document, the calculation, the beneficiaries. There is literally nothing that the IRS will ask you for in an audit because you've given it to them. Now, they might send you a letter saying, hey, we don't like what you did, but I will tell you that since 2011, when we really started doing CLATs, we haven't heard anything from the service on any CLAT we've done. And I assure you, when your client makes $300 million and you do a $100 million CLAT on his return, somebody looked at that return. It does not go unnoticed. So
Yeah, those seem like some pretty big numbers. We did have a question about how small of a value you could really start considering to use a CLAT. Like, is that something that you would consider for a client that has $10 million, or where is that line?
Where's the line? How much is the lawyer charging you to do the CLAT? And is it worth the, is the juice worth the squeeze? Yes, but yeah, I mean, I know people that have done CLATs for hundreds of thousands of dollars just because it was, listen, I in my reading years ago doing CLATs, there was someone had mentioned something called doing a poor man's CLAT. And a poor man's CLAT was setting up an annuity and naming the charity as the irrevocable income beneficiary of the annuity every year. And there was no need to actually have a trust document involved, because in formality, that's exactly what you did. You irrevocably assigned the income from an annuity to a charity, and you get a deduction for the present value of all the payments the charity is going to receive. I mean, in essence, that's a CLAT. So you don't really need a formal trust, although I would highly recommend doing a formal trust document and so on. But yeah, poor man's CLAT, that's what they had referred to it in this article. I thought it was a brilliant idea. But
yeah, it's a very good idea. Absolutely. Okay, let me do a quick polling question. Polling question number 3. A charitable lead annuity trust, a CLAT, A, receives a gift and makes annual payments to charity. B, what's left at the end of the CLAT term is not subject to estate tax, can be held for a spouse, children, or maybe even revert back to the grantor if that's what the grantor wants. C, a zeroed out CLAT is based upon numbers so you don't use any estate or gift tax exemption, yet there's a lot left for your descendants at the end. D, a lifetime CLAT that you do during your life can create a significant income tax deduction because you get an income tax deduction for what you put in there, although you do pay the income tax on what the CLAT earns during the CLAT term. So you end up saving a lot of income tax in year 1, then maybe paying a little bit of income tax through the rest. And E, the correct answer, all of the above.
I want to bring one other thing up. And sometimes this is known as the Jackie Onassis option. Rumor has it that Jackie Onassis had a option to do a testamentary CLAT in her will. And we use that often when we're doing planning for clients clients that have transferred lots and lots of assets to their children during lifetime and are left with a residual in their estate that they're not willing to give up so easily, but may have a large estate tax against it. So since when mom and dad pass away, the children are well healed by themselves from all the gifts during life. Maybe in mom and dad's will, the residual of their estate falls into a charitable lead trust. So for a period of years, the charity gets a value equal to the value of the estate, plus the hurdle rate. And at the end of the term, whatever's left over in that trust now belongs back to the children again. And in essence, you've been able to zero out the estate for estate tax purposes. And 10 or 15 years from now or 20 years from now, the children get another slug of assets from the estate, which is the excess above the assets that were in the estate plus the hurdle rate that the charity got.
That's excellent. So let me show an illustration here that might be helpful. So this would be a testamentary clat. So when I sit with clients, Ed, and I say, well, I can do all this estate tax planning and I can do all this fancy stuff, but you're still going to owe some estate tax. Or instead of the fancy stuff, would you just like to leave it to charity? So here's a situation where this individual would pay estate tax of 11 million, and what's left for the descendants is 43 million. But I can click on charitable testamentary charity on the far right bottom, and now it shows me that instead they can leave 0 in estate tax, 62 million to charity, and the kids get 55 million. So, you know, just looking at that, and I'm sorry, I got the numbers wrong. Before the planning, it's 93 million to the children, 25 million to the government. Or if they leave it to charity, charity gets 62 million, the kids only get 55 million. So it really, when you leave everything to charity, it sounds good because there's no estate tax, but the kids get less, so the charity gets more than the IRS would have gotten in a 60-40 proportion. Although the charity could be a foundation run by the children. But I can go here to the left and I can say, let's do a clat instead. And let's assume that this clat in the end is giving 60% of over time to charity, 40% is left for the descendants. So now there's still 0 estate tax, and the clat still gets got the 62 million that the charity would have gotten. Charity ends up with 37 million over a term of years, and the descendants after that term of years, in this case 20 years, get 25 million. So that a client's more likely to do a testamentary clat. There's no income tax deduction because you wait till you die. Then the client says, well, you know, my son would probably go for that. He's a wealthy physician. He's very charitable. He'd probably love to run a foundation. My daughter would not go for that. Well, what you can do, and this is what Jackie did, is the document says half of my residue goes to the trust for my son. But if the trustee, or to the extent the trustee disclaims it, it goes to the clat. So then the son can sit down with the trustee and tell the trustee, please disclaim all of it, half of it, 2/3 of it. They can run the numbers. They had 9 months after Jackie died to decide how much would go to the clats, and reportedly they decided, nah, let's just keep it. Let pay Uncle Sam the full estate tax. I believe that's what happened, or that's what I'm told happened. So, anything else on clats before we go to crats?
So another split interest trust. You put assets in the trust, and here the donor gets back a payment every single year. And at the end, the charity gets the residual. And you get a deduction for the future value of what the charity is going to get. The higher interest rates are, the more beneficial charitable remainder annuity trusts are. The lower interest rates are, the less in favor they are, and the more clats are in favor. It's just the way the numbers work. Interestingly, a charitable remainder trust is tax exempt. An asset that is in the trust that is sold does not recognize taxation on the sale, but as the donor takes money out of the charitable remainder trust each year, that payment is taxable, and is taxable on a layered schedule. Alan, you could probably go into more detail about whether it's how capital gains, ordinary or other. But the payments back are not tax exempt to the donor. But the donor does get an upfront tax deduction for what the charity will receive in the future. And that can offset the taxes that are due on the first 6 years coming out of the trust. Again, no greater than 30% of adjusted gross income in any 1 year, carried forward for 5 years after the first year. This will become a very popular technique again if interest rates continue to rise. When I first started in the business in 1990, I think the 75-20 rate was close to 10. And we did a lot of these. Now, again, I'm going to put on my insurance broker hat. So if dad and mom put an asset into the charitable remainder trust, and they get back an annuity income for, let's just say, the term of years is the life of both the donor and the spouse. In essence, whatever's left over at the last of them to survive goes to charity. And the kids get cut out. Well, if you take out your sharpened number 2 pencil and you say, well, if I put an asset in today worth $10 million and I keep the income for my life and my wife's life, and then at the end, my children lose out on that asset that would have been in my estate. Well, I assure you that if you take a look at the tax deduction you get and you do the math against your taxes and see how much money you're actually really getting back, that number will be equal to or around the same amount of money that it would cost to buy a second to die life insurance policy that will replace the value of the asset to your children. So you get to have income during your life and your wife's life. The charity gets a huge slug of money at the end of your lives, and your children have a replacement trust that is populated with life insurance that matures upon death, so they get an equal value. So it's almost the perfect scenario in the sense that it's a trifecta. You get money for the rest of your life, your wife gets money for the rest of her life, charity gets a huge lump sum, and your children get a huge lump sum. It is a highly efficient vehicle for planning.
Right. So if I'm going to sell a property for $1 million and have a $900,000 gain, I could put that $1 million property into the CRAT, the Charitable Remainder Annuity Trust, get a little bit of tax deduction based upon the charity share of the CRAT in year 1. Then the CRAT sells the $1 million asset. I pay no income tax on that sale. The CRAT pays no income tax on the sale. And then the CRAT makes payments to me, which can be a term of years up to 20 years, or life, or joint life. So if I'm in a high income tax bracket because I'm working, then this allows me to defer the income from the sale of that $1 million asset over 20 years or over my lifetime. And what happens is the income accumulates within the CRAT, and when the CRAT gives me a payment, the income comes out to me and I pay the tax only as I receive the payment. And it comes out, we call it worst first, because if the CRAT has some capital gains and also some ordinary income from dividends and interest, and when it gives me my money, the ordinary income comes out first, and then the capital gains comes out second. So,
Alan,
yes.
let me ask you this great question, because this has come up before where I've had to burst another advisor's balloon a little bit, I think, and I just want to make sure I'm right. Let's say we sold the asset for $10 million. There was no basis in it. So now the charitable remainder trust is sitting on $10 million, and the trustee invests all of the money into tax-free municipal bonds, and all of the income that are coming from the bonds are used to make the annuity payment back to the grantor and their spouse. What was purported to a prospective client of mine said that, well, you don't have taxes then because all of the income coming out of the charitable remainder trust is tax-free income. And I said,
Nope.
bull crap. You have to recover the taxes on the asset that was sold over the period of time.
That's correct. There was also a recent tax court case where a farmer put, I guess, wheat or corn into the CRAT, and then the CRAT sold the wheat or corn and bought an annuity contract. And then the annuity contract paid out from the CRAT to the taxpayer. And they tried to say that the payments were not all taxable going back to the sale of the inventory, that you would follow the annuity contract payment rules where you get a lot of tax-free payment. Well, the judge said, forget that, even though the farmer read it in a magazine that he could do that. But the interesting thing I want to mention is the judge did not say that the deferral of the income from the inventory of wheat wouldn't work. So you could, at least according to this case, put ordinary income assets. If I'm a widget manufacturer and I want to set some widgets aside into a charitable remainder trust and then sell those widgets, instead of having ordinary income, pay no tax the year of the sale, and then over time, it can be quite good. Now, Ed, you chose the CRAT, where with a CRAT, you get an equal annual payment every year. It doesn't increase with inflation. It doesn't increase if the assets of the trust increase. Do you want to just mention the CRUT?
Sure. So on all of these charitable lead annuity trust or charitable remainder annuity trusts, when they use the term annuity, you're taking a percentage of the initial value of the asset out each year. So all of your payments, whether they increase, decrease, go sideways, is all based on the initial value. When you do a CRUT, a charitable remainder unit trust, or a charitable lead unit trust, you're taking your percentage off the then market value of the asset. So if it says that I have to take out 10% a year of the value of the asset on an annuity trust, it's of the initial contribution. And on a unit trust, it's on the market value that year. So for a charitable remainder trust, a unit trust may be something that may be more advantageous to the donor, because if the assets increase in value each year, so does their payment. That may cause other issues. If it's not marketable securities, you may have to go out and get formal valuations every year. There's plumbing. And again, is the juice worth the squeeze? But for a client that believes that the asset structure of the trust is going to increase substantially over time, and they want to benefit from that increase, then you should look to the unit trust, not an annuity trust.
Okay. Now let me see. Did I do the polling question for CRATs?
Yes.
I did? Okay.
Oh, wait, no.
No, I didn't. Okay.
I'm gonna redo
So,
it.
charitable remainder annuity trust. This is the last polling question. A, it makes an annual payment to a person for a term of years, which could be up to 20 years as a term, or for life of one or more people. B, with a CRAT, the payments are always the same dollar amount. With a CRUT, they're based upon a percentage of the value of the assets each year. C, what's left after the term goes to charity. It could go to a family charity controlled by the family. D, it can generate a large charitable deduction. And because the payments are fixed, a retiree can be certain as to the amount they will receive. Now, some clients do half in a CRAT and half in a CRUT. So if values go up, the CRUT takes care of that. If values go down, the CRAT assures them a minimum amount. And E is all of the above. By the way, when we're done with Ed and he goes back to his basement to bail out the water, because New York's been getting rain like crazy, Joey and I are going to stick around and go through how Estate View software is now working. Estate View software is still free. We don't expect to go commercial until next year. If you want to test it, all you have to do is go to estateview.link, and we'll send you instructions if you like, but you just go to estateview.link. You put in your email address as being test, T-E-S-T, at test.com, no capitals. And then your code, secret code, don't tell anyone, is the word test, T-E-S-T, no capitals. All right, so that takes care of polling 4. Ed, we have 5 minutes for the Qualified Personal Residence Trust, and then we can come back another week and really hone in on it if you like, because you're doing a fantastic job.
Yeah, this is quick overview. Again, another split interest trust, except remember in a GRAT, we put an asset into the trust, we take back an annuity payment of value each year. In essence, we're eroding the value of the asset by the money or dollars that we're taking back each year. And if we take back more than 100%, which is the value plus the hurdle rate, in essence, we gave our children nothing, even though it may have increased in value. A QPRIT is identical to that. We're doing it with a house. Now, a house doesn't produce cash flow, so the living right or the enjoyment right of the house is what's coming out every year. And the IRS calculates what this is. So if I set up a trust and I put my house in it, and I have the right to live there for a period of years, at the end of the period of years, the house now belongs to my children. And if it's done correctly and the interest rate environment is high enough, you may even get close to zeroing out the value of your home. In a low interest rate environment, this doesn't work very well. In a high interest rate environment, it works well because in a high interest rate environment, that's what the living benefit is. Let me tell you the good, the bad, and the ugly. The good thing is you got your house out of your estate. Bad thing is, let's say at the end of the period of time, it now belongs to your children. It no longer belongs to you. There are some big issues if there's a mortgage on it and you continue to make mortgage payments. There's a big issue because it belongs to a trust for your children. You must pay market rate of rent to your children to live in that house. And let's just say if that house is sitting on a beach someplace, I assure you the market rate of rent is substantially higher than you could ever imagine. Out here in the Hamptons, it's not uncommon for a house to rent for $50,000 to $200,000 a month during season. There are houses that rent for more. Not any house that I've ever rented. I don't have Alan Gassman money, but it could be substantial. Now, there are some by the way, if you die during the term of a QPRIT, just like a GRAT, it all folds back to your estate as if it didn't happen. Now, let me tell you some of the things you can do in my quick time to turbocharge this. My wife does a QPRIT for 50% of the residents in her New York City. So we changed the titling from tenants with rights of survivorship to tenants in common. My wife owns half, I own half. Alan, is half a house worth 50% of market value?
It is not.
Right, because if I want to do something, you need the permission of both parties to make a change.
That's right.
Try to convince my wife to change the paint color, the draperies or something. So, it's just not going to happen. So you would pay less for half. So let's say my house was worth $5 million and my wife took her half and made a gift to a cuprit. I assume that we're going to get somewhere in the neighborhood of a 10 to 20% valuation discount for 50% of the value of the home. Now, interestingly, after the time period ends in which the cuprit ends, I own half the house and my children's trust owns half the house. Alan, do I need to pay rent to my children? Do they need to pay rent to me?
Yeah, I mean, if your children's trust owns half the house and you're living there, then you would pay your children's trust the rent.
But they would need to pay me because in essence they own half. So it's reciprocal. You don't have to pay rent to each other as long as I'm alive. And then I do the same thing with my house at the beach. I break that into two pieces. I and tenants in common, and my wife is a tenant in common, and I take half my house in the Hamptons and get a 20% discount on the value, and I do a cuprit. So in essence, we've gotten 100% of the value of half of each of our homes out of the estate. And we don't have to worry about the risk of living too long and having to pay our children rent. Now, there was an article written back in the early 2000s called a cuprit risk. That is a cuprit with a sale of a remainder interest. So the value of the gift that you're making to your children is calculated with this remainder interest. There's a section of the code that says that if there's a qualified purchase of the remainder, you lose the mortality risk in the transaction. So if my children's trust bought the remainder interest from this, and I died, it doesn't revert back to my estate. For those of you who want to copy that article, I'm sure I could dust it off somewhere, but it was called the cuprit risk, the cuprit with the remainder interest sale. When you split the properties in half, take discounts, do the remainder interest sale, you really turbocharge this transaction and it makes it worthwhile to do. I will tell you that the biggest problem in proposing a residence trust is that your client will tell you horror stories about when someone at their club gifted their house to their children and their children threw them out of the house. Nobody wants that.
Right.
So
my cuprit is for the benefit of my wife, Marcia, and my descendants. I could draft it so that if Marcia passes away, my next spouse could be a beneficiary of it. I can control who the trustee is. So it's not like my children have any voice, but if I'm going to continue to use it past the term, I'm going to have to pay rent, which is going to further reduce my estate and save a house load of estate tax.
Whether you say your next spouse,
She's not working today.
So I'm going to end this with a joke since you brought up next spouse. So a husband and wife are sitting in a restaurant speaking, and the wife says, honey, if I were to predecease you, would you remarry? The husband looked at her and said, I probably would. I really don't like being alone. And his wife says, well, will you and your new wife live in our house? He says, sure, I love our house. We built that house. It's gorgeous. It's everything I wanted. Is she going to sleep in our bed? Sure, I love our bed. I mean, we spent $20,000 on that stupid duck sienna mattress that you insisted on. It's the most comfortable thing in the world. Why wouldn't she sleep in our bed? And the wife says, is she going to use my golf clubs? He says, no, she's a lefty.
I'll make sure I tell that joke to Marcia tonight. I'm sure she'll really like it.
So if you want to do 6166 real quick or save that for next time, we could do that.
Well, why don't you just tell them, why don't we just spend 1 minute so they just are dying to hear more about cuprits in 6166 next time?
Oh, 6166 is the worst thing you could do for a client, and most people really don't qualify. 6166 is basically a 15-year deferral to pay estate taxes on business assets. One thing that most people don't tell their client when they're discussing this as an option is that the federal government has a federal lien on your business assets. Good luck leaving your business to your son, your daughter, without you being there to help run the business and burden them with a federal tax lien on the business. Please just buy the life insurance to pay the estate tax. It saves a lot of burden. There's a family in New York City that my father was friends with. The son was 60 years old when his father died. They did a 6166 on all of the real estate in Manhattan. The son was in his 70s before he fully inherited the property and literally almost buried the business because they had an inability of refinancing it at a reasonable rate with a federal tax lien on their properties. It was not easy. In addition to that, we've come across a lot of people, especially in the real estate business, where mom and dad retired to Florida, and dad really wasn't involved in day-to-day operations anymore. The next generation was signing all the work orders. They were signing the leases. They were hiring and firing janitors. And mom and dad passed away, and the accountant went to apply for a 6166. And the first thing the IRS agent asked for was all documents in the last 24 months in which the client signed related to the real estate and the properties and its management. They couldn't produce anything. And the IRS said, you don't qualify for 6166 because this wasn't an active business. The decedent was nothing more than a passive real estate investor.
Mm.
And that may not be the plan, and dad may say that I'm going to continue this until the day I die, but they may become incapacitated, and that might change the game at a later date when you really have little else to do. So I'm not a big fan of it. I put my insurance hat back on. I just tell people, you've already bought the insurance. You volunteered to pay X dollars in taxes. That's your premium. If the premium for the insurance is less, you're probably off just biting the bullet and buy the insurance.
I will say, though, for the CPAs watching, you do have a lot of clients that have triple net leases and passive leases, and they could consider making them active. Go back to the tenant and go, guess what? For very little money, we'll add maintenance to some extent. For very little money, we'll add janitorial so that your client can get the Section 199A 20% deduction, which hopefully won't go away in 2026. But at the same time, at least your client, if your client qualifies for the 6166 payment plan, it is a pain and most people don't want to use it after they figure out what it's about. But at least the first 4 years, there's only interest payments, and then another 10 years amortized. So some clients do use 6166, but it is not, as they say, a panacea. So Ed, thank you so much. We will go ahead and schedule part 3 for the next Saturday you're available.
Great. Thank you very much. Enjoy the weekend.
Yep, you too. Take care. All right, so Joey and I are now going to talk about my favorite subject in the whole world, Estate View software. And let me just bring it up here. And this is not for credit. This is just if you are interested in Estate View software. So the first thing you'll do, top left-hand side, you'll type in estateview.link, and then Estate View comes up. Now, if you haven't used it before, when it asks for your email address, put in test@test.com, all lowercase. And then when it asks for your name or your code, put in test, TEST, all lowercase. And then this screen comes up, says Estate View software, hello, Estate View user. And there are 3 categories of buttons: comprehensive plans, calculators, and my account. So the comprehensive plans are for a single client, which looks like this, or for a married client, which looks like this. It looks the same, but there's 2 spouses. And let me just show you the inputs for the married clients. But before I do that, I'll just note that there's presently 8 calculators. One is the QPERT, Qualified Personal Residence Trust, and another is the Charitable Lead Annuity Trust, which you can go ahead and open and run numbers to reinforce what you've learned from Ed's excellent lecture. And we may have time to do that. But let me go back to a married couple. Now, this software is running on my computer based upon an engine in the cloud. And this software can run on your phone, not very well to see, but it can run on your phone. It can run on your iPad. It can work fairly well on the iPad. We don't have all the visual kinks out, but I would say it's completely usable on your iPad. And it can run on an Apple computer. It can run on a regular computer. Joey, anything to add to what I've said so far, being the computer expert between the 2 of us?
No, I just wanted to repeat, the username is test@test.com and the password is test, T-E-S-T. You should be able to log in there and get to that dashboard screen where you can go and explore and follow along. Also, to get to the website, again, you just go to estateview.link. It's like going to google.com, but instead type in estateview.link.
Now, you don't search estateview.link. You put it in your browser, which most of your browsers are in the top left-hand side. Right. So then once I open this, whether it's going to be a married couple or a single individual, there's basically a 3-column approach. The left column is my information that I'm inputting and the controls over the software. My middle column is the displays, and my right column is the planning scenarios that Estate View will show you and let you work on. So really quickly, to oversimplify, I've got Bob and Mary Sample. I input their names. They have a $3 million residence and $50 million of investments. And Bob's going to die in year 10. Mary's going to die in year 20. Now, there's a lot more information inputted, but to show you, if I click the top right, it demonstrates what will happen if they both die this year. So I click on top right, and it shows me that they will pay a $11 million estate tax, and their survivors will receive $43 million if they die this year. And by hitting fit full, my display will be lined up. Now, what happens if they die based upon the years of death that we input? He dies in 10 years, she dies in 20. I click no planning. Now it shows me a $38 million estate tax, $80 million to the descendants. Then I can click on the other planning techniques. Let me turn them on there. I had turned them off during Ed's talk. What if on the first death there's a credit shelter trust that's funded to benefit this the surviving spouse for life and is never subject to estate tax. I click that. There's the credit shelter trust. Now the estate tax is down to 35 million. What if they do qualified personal residence trusts? I click Cupert, and I'll talk later about how the Cupert works, but it shows me the part of the home that they put in the Cupert and a lower estate tax, shows me the value of the home on the second death and how much came in from rent. And you'll notice that when I click the next module on the right, the inputs for that module show up on the left. So I'll click, for example, discounted gifting on the right, and on the left, it took me to the gifting module. And in the middle, it shows me what happens with the gift trust. Then I have life insurance trust planning I can do. Then I can do an installment sale. And then I can do what's left to charity or a charitable lead annuity trust. And before I go into more detail, I'll just also mention that there are three ways to view this. There's trust logistics in the middle, which I've shown you. Then if I click on timeline, it shows me these trusts as they grow in different colors so that I can see, based on the year they die, what the tax would be. The tax is always in red. And I can actually move the year of death of the first dying spouse to see if that makes a difference. Then I've got a details that it can show me the main numbers behind the technique, or annual amounts. It can show me exactly what numbers went into a particular trust to allow that technique to happen, or to show me exactly where the assets went. So you can basically double check and make sure the software is doing what you expected it to do. And as I said, when you want it to fit perfectly in the middle, you click full fit, or if you want it to fit width-wise, you click fit width, and then you can scroll down. Another feature I'll show you before I get into the detail of it is I can go to generate client letter. I can select what scenarios I want the client to see in a letter. I can select which views I want them to see. Then I click generate client letter, and it generates a letter to the client explaining the inputs, explaining the client information, and explaining the estate tax system, and explaining each of the techniques. I won't get into that right now. When I have this where I want it, where I have the savings where I want it, if I would like for the client or a colleague to be able to pull up the software and use it with these settings that we have put here, I can click share with client. It sets up a code, which is random, or I can customize the code. It's a 5-digit code. I click generate URL. I click copy to clipboard. Now it's in my cursor. Now I can go start an email and click paste, and then the client will get the link, and I can tell them their code, and then they can open this and use it on their own based upon their names, their ages, and their being able to change most of the calculations. And we found that clients really enjoy playing with this. So, Joey, anything I've missed here from a big picture standpoint? You can go to File, and if you want to start a new scenario, you click New, and it gives you a brand new scenario you can start with. If you click Save As, then you can give this a name, Jones Part 1, click Save, and it saves all the data for later use when you come up and use it again, so you don't have to revise everything. I can take a screenshot and save a screenshot. So that, and then I go up to this arrow pointing down in my Google system, and I can find all these things that I've put together. All right, so getting into more detail on the inputs. The inputs run along the left, but I was getting claustrophobia working with the inputs all in one little column. So I asked our wonderful programmer, Kevin Gray, to enable me to change the input by clicking here with the arrows pointing out. The input now takes the whole page. So now it's much easier for me to input the information without getting claustrophobia. Or if I wanted to go back to small, I click the X. The other, let's see, or I click the arrows again. Now, there's shortcuts to the assumptions. If I just want to change the residence, I click residences. If I just want to do the installment sale, I click to installment sale. But these shortcuts take up some space on the screen, which some people prefer not to have the shortcuts there while they're inputting the information. So I can click here to show/hide the shortcuts. So now back to the inputs, going to the top of the inputs. First, which strategies do I want to use? Well, usually we use all of them. But if we decided we didn't want to use life insurance, we could just click that there and it wouldn't show the life insurance strategy or the life insurance involved. Then I can put my name here under planner name. I can put my firm name. Then I can put the name of the client, first and last name. We typically don't put the client's actual name there because the client may want to show this to other people. We don't know who's going to see it. So we like to stick with Bob Sample and Mary Sample. And then we can put in a date of birth or a year. If we put in the date of birth, it will tell us how old the person is. Male or female, tobacco smoker or not tobacco smoker. That's going to tell us what the actuarial tables say that the person's longevity is. And then we decide when we're going to actually kill them off in the illustration, which sometimes the numbers get so big it's not even believable. Please keep in mind that your clients will probably live longer than what the actuarial tables say because wealthy people take better care of themselves. The lifetime exemption that they've used so far, right now they have a 12,920,000 exemption, but maybe they've made $1,250,000 of gifts in the past. Okay, then how much is this person either saving or spending from their savings? Now, let's say that they have 10 million of investments growing at 6% a year. That's fine. But are they spending from that pool every year, or are they adding to that pool from salaries, pension plans, gifts that they're receiving? So the first spouse perhaps is saving $300,000 a year and intends to do so until age 76 when he will retire. And then after that, his net spending will be $325,000 a year. So you basically get two tranches. Now, the other spouse, same considerations. And once the first spouse is deceased, will the other spouse have net spending or net income? And by the way, when you hover over a lot of these things, you'll get a little bit of an explanation as you see for what's happening. Now, these numbers, the 300,000 savings, the 325 spending, they will be adjusted for the CPI rate each year. Now, will portability be available or not? Or you could show it one way and then click for portability and show it another way. Will the exemption go to half in 2026? For a lot of clients, we're showing them one set of illustrations with, and then we're just clicking this and showing them the same exact illustrations without the exemption going down to half. Estate tax rate 40%. We do not have this for any of the state estate or inheritance taxes, but if you're in an 8% inheritance tax state, you could go move this to 48%. It's not going to be perfect, but it might give you a better representation. Otherwise, just keep it at 40% and explain to the client that their taxes will be higher because of the state estate tax. Chained inflation, which is what drives up the estate tax exemption. The average has generally been about 3.71%, but if you want to say that inflation's going up, you think it'll be 4.245, whatever, you can either slide it with this ball or you can adjust it up and down with the arrow. And then what is real inflation? If you are going to later tell the client, well, let me show you what it really means with the time value of money, you can guess what real inflation will be. Joey, anything you want to add? Anything I've covered so far?
So you talked about the growth that somebody can have based on saving or spending. I think that's a good point to mention these values, all these number fields. You can type in like 1M and hit enter, and that'll change it to 1 million for you.
So I hit 35M and click return, and it's 35 million. Or I could click 35B. Oops, sorry, I gotta break that out. I could click 35B, hit return, and it's 35 billion. Or 35K and click return, and it's 35,000. So thank you very much for programming that, Joey.
Yeah, and then also there's the lifetime gift exemption used on the client profile. I don't remember if you mentioned too much about that, but it's just a way for clients to account for any gifts they've already given or plan to give pretty soon. That way that can be taken out of their exemption amount.
Right. Now, we did show you that there were two buttons you could push. You could go married or single. If you want to show a client what would happen if they were single, or if you would like to murder their spouse, from the married, the only difference is you click here, spouse 2 disappears, and if you're in single land, now the questions become, is there already a credit shelter trust? And if so, what's in it? And what's its name? Gassman Family Trust. You can mention what the portability allowance is and how much the portability allowance is for the client. And so that's really the only, if you go, everything I explained here for married is going to work for single, but when you go to single, these are the only different inputs that you will need to use. Okay, so business and investments, we only have 2 types of investment assets. Current value for the mainstream investments, an annual growth rate, what the annual investment costs are, and what the annual income tax is as a percentage of the value of these assets. The second asset, other than their home or homes, will be the explosive asset. Because a lot of clients come to us and say, wow, I need estate planning right away because my business, which is presently worth 5 million, is going to be worth 23 million in 3 years if my patent comes through. Well, when you sell for 23 million in 3 years, what will the income tax be? 2.5 million. Okay, would you like to put that explosive asset in whole or in part into an installment sale? And then if the answer is yes, then the question is what percentage? And you can use these numbers, and we're going to show this again in the installment sale, but this is a new feature, and we really needed this because of a lot of clients do say, well, here's my investment portfolio, but here's my company, and my company's going gangbusters. So that's what that's for. Okay, then all your residential properties under one number, the growth rate and the present value. And then do you want to show 1 or 2 Cuperts? So if there's no box checked, it's not going to show a Cupert. But if you check the box, it'll show 1 Cupert. Maybe you only want to put 70% of the home into the Cupert, maybe 100%, whatever you decide. And then if you're doing 1 Cupert, how long will the Cupert term be for a 4 million home? 13-year Cupert, and the gift tax exemption used is $1.5 million. And then after the 13th year, if you pay rent, what percentage of the home will you base it on? Say 8% is probably what we're seeing most often, so that it can handle. Now maybe I want to do 2 Cuperts. So now I've got 2 Cuperts. They'll each do 1/2 of the home using a 15% valuation discount, and maybe 1 Cupert for spouse 1 will be 9 years, spouse 2, the Cupert, maybe 16 years. It's more for illustration than it is for determining strategy because we have a Cupert calculator, but this allows you to get a little bit of calculation and to show the client. Now, will there be a credit shelter trust, also known as a bypass trust, on the first death to benefit the surviving spouse without being subject to estate tax? Yes or no? If yes, do you want for it to calculate the maximum amount that can go into the bypass trust? If so, we know that that's 22 million based upon all these situations. Now, if I move this value down to 33 million, then the maximum bypass trust should go down as well. So we have to talk to Kevin about why it didn't just then. Yes, we're still getting kinks out of this. Okay, then annual gifting. Have you already got assets in a gift trust, maybe worth $1.2 million? And how many gifts can you do a year? Maybe you've got a married couple with 4 children for the next 10 years, and then you think they're going to have an average of 8 children thereafter, because there'll be less later. Then do you want to gift directly, or do you want to use LLC interests? And if you use LLC interests, what discount rate? So let me just show you where we are so far. I'll click back to the normal setting, and I see we've got Bob and Mary worth 38 million, $4 million in residence. They've also got the exploding asset that's not showing yet. And after the first death in year 15, the investments with the exploding asset are 108 million. And the estate tax on the second death, 37 million without planning. Now with the bypass trust funding, which I'll click there, the bypass trust gets 22 million. There's some small amount of estate tax planning there. $2 million of estate tax savings. Is that worth it? because on the second death, you're not going to get a step up in income tax basis from the bypass trust. So I would think carefully about whether we're going to do the bypass trust. Now, what if we get the Cupert done? There's your Cupert 1 for half the house. The house, which starts at 4 million, is worth 8 million 4 in 19 years with growth. The first Cupert has 2 million 1 from rent and reinvestment of rent. The second Cupert has $1 million because the second one was the surviving spouse. So that's all taken into consideration.
And Alan, can a surviving spouse set up 2 Cuperts like this, or is that only when both spouses are alive?
Any person can do 2 Cuperts. So if Marcia and I have our home and 2 investment homes, I could do a Cupert of our primary home and one, I'm sorry, not investment home, second homes, residences. So I could do a Cupert with half of our primary residence plus our vacation home. And then Marcia could do a Cupert with the other vacation home and perhaps half of our residence. All right, so then I go to annual gifting, click on annual gifting. Now I see the gifting trust, what it's worth, $1,250,000 in the beginning. And I'll make this just a little bigger. And then what the gifting trust goes to at the time of the first death, and then the second death. So that's the gifting trust. Then what if I'm doing discounted gifting? Well, now the gifting trust will go from 10,340,000 to 12,449,000 when I do the discounted gifting. So let me now just go to charity, because the life insurance and the installment sale is more involved and a lot of people aren't going to use them. So I will turn off life insurance and I will turn off the installment sale, and I'll just go to charity. Now, this is not a thorough charitable calculator. We do have a calculator for CLATs, but many clients will just say, I wanted to go to charity. So I click to, and let me go ahead and expand this. So on charity, I just click to charity, and then what portion of the residue is going to go to charity, 100% or 60%, whatever it would be. So what that does for me, I can go down here, click on charity. So if I leave 50% of the residue to charity, charity gets 32 million. The estate tax is 13 million. My beneficiaries get 97 million. But I can, as I click up and down on the 50%, I can see what the numbers turn into. And the client may just want to click up and down until they decide what level they like. Or the client may prefer to do a charitable lead annuity trust. So I'll click from charity to charitable lead annuity trust. What portion of the estate will go to the charitable lead annuity trust? Usually it'll be 100% because the client doesn't want to pay estate tax. What percentage of the CLAT will go to charity? Well, maybe I know from my calculator that charity is expected to get 50%. How many years will the payments to charity be? Maybe 22 years. So now when I click on charitable, what is it going to show me? It's showing me no estate tax, and it's showing me 65 million to the CLAT. 32 million of that is ending up going to charity in years 1 through 21. Year 22, at the end of year 22, my descendants get another 32 million, so they get a total of 110 million. And I can simply scroll up and down depending upon what we're doing. Now, in some of the settings on Estate View, you will run into red. And if you are saying to the client that the charity is going to get less than 50%, we are saying, be cautious. It may not be possible to have the charity receive less than 50% of the present value of the CLAT. That assumes some factors that planners may not understand. Okay, so that takes care of charity. Joey, anything you want to mention?
I just want to say that's a great way to give back to a charity. And like you mentioned a couple times during the webinar, that can be a charity that you're in charge of or your beneficiaries are in charge of. So it's a way for you to give back to the community or a cause you care about while still retaining control of how that money is spent to make sure it can really impact the cause that you're trying to impact.
Right. That's absolutely right. Now, I forgot to mention something, and I'm just going to go there so I don't forget it again. You see the word explained here and here. We believe that there will be some confusion on these inputs about how much are you saving a year until what age, how much are you spending a year until what age. So when you click explained, this will explain the settings for the annual additions. We're going to improve this explanation, but it's still helpful as it is now. And that explanation, Joey, if you'll remind me, we also need to make sure that the explanation letter explains it. Okay. Now, back to the life insurance. We think that life insurance agents are going to like this. But the first thing I'll show you, which is for those of us who are not life insurance agents, a lot of times the clients come in and you say, well, we're going to do this 10-year GRAT. So you need to go out and get $50 million of life insurance. And they go, well, how much does it cost? And you go, I have no idea. I don't know. Well, what you'll be able to do is click on estimates, male or female, and whether they're standard or preferred, and what the age of the client is. Let's say the client is age 46. And how much would a 20-year term life insurance policy cost per million? $2,045. So they need 20 million. That's going to be 44,000 a year. Now that's not set in stone, but at least they can get an idea from you. Or the client's 63. Now you see it's 12,000. So this is going to be improved, but at least it's going to give the planner immediate information on what it would cost for a 20-year term, 30-year term, or a guaranteed universal life. We're just getting this data from 2 or 3 different carriers. We're averaging it. We're not promising that this is a result. We're not trying to sell life insurance, but we just think an estate planner should know. You meet with a client and they say, how much life insurance do you think? Well, if I were you, I'd have 5 million. So if you die, your kids and spouse aren't on the street. Well, what will that cost? Well, now I can tell them what they should at least think that it might cost so they can make a tentative decision in my office and go forward. Okay. Now, for life insurance, we can do policies on spouse 1. Let me just go to 0 here. So spouse 1, I want to have a life insurance policy. I click add policy, and it begins with a permanent life insurance policy, not in a life insurance trust. Now I can change from permanent to term. And then the next question is number of years. How long of a term? Okay, let's say it's a 20-year term. Annual premium, $8,000 a year. Will there be a second tranche? Usually not. So I'll put this at 0. So they're going to pay $8,000 a year for 20 years. The death benefit for those 20 years is going to be $1 million, or $1,150,000. After 20 years, there's nothing. So I'll go that to 0 there. All right. Now that's pre-planning. What is post-planning going to be? Well, post-planning is going to be first copy this policy to post-planning. So now I have the same exact policy, but post-planning, it's going to be in an ILET. So I'm going to show them their $1 million term policy first outside an ILET and then in an ILET. Now, the second spouse, maybe she has permanent insurance and it's already in an ILET. And maybe it's $8,000 a year premium for the first 12 years, $4,000 for the next 15, $600,000 death benefit for the first 13 years. Then it goes to an $800,000 death benefit. And then if I'm going to copy that to her post-planning, I've got the same thing, still in a life insurance trust. It's just not changing. Then right now, second to die, they don't have this. We have the same numbers for a second to die. Let's change it just a little bit. And it's not yet in a life insurance trust. So I can click on copy to post planning and it's in a life insurance trust. And then and you can have an infinite number of policies. So I could add another policy for number 2, whatever I want to do. So now I can go to the life insurance module. Well, first of all, you'll notice that since I've turned life insurance on, it's showing me the life insurance in all of the scenarios. Yellow means it's estate taxable. Purple means it's not estate taxable. And when I click to the life insurance planning, what was estate taxable yellow becomes not estate taxable purple. So, and it will keep track of, well, you didn't pay anything if you didn't die within the 20 years. It does keep track of all of that. Okay, so now I'll go to the installment sale. Now, and I'll find it by clicking installment sale. There it is. Go ahead and open it up. Now, I will show installment sale by clicking there. It's telling me that I have an exploding asset situation. I can decide what my seed capital gift is going to be. Do I want it to be 10% of the sale amount? So let me turn off the exploding asset for a minute so we can make this easier to understand. So I've turned off the exploding asset. No exploding asset right now. Thank you very much. So how much do I want to put into the installment sale? I go here and let's say I want to put 20 million worth of assets into the installment sale. So I go to put that to 20 million. And then what's the discount rate I'm using for the LLC? Let's say 25%, or let's say 30%. So I've got 20 million. It has a mind of its own there. So I've got 20 million in an LLC with a 30% discount. I'm going to sell the 99% non-voting member interest for a $14 million note. And I need to do a seed capital gift. If I do one, if I wanted it 10%, it's at $1.4 million. Now this saves a lot of time for the planners because the client may say, well, what if I want to put 16 million in? Well, I just toggle this up to 16 million and then it automatically tells me my discounted sale amount And I mean, how much I need to put in the LLC? Well, what if there's only a 25% discount? Well, now it tells me what my sale amount is at 16 million, etc. The interest rate on the note, it knows that I'm going to use the applicable federal rate, the long-term applicable federal rate, which is the lowest of this month, last month, and the month before, which I believe is 4%. If I want verification, I can click on AFR. And when I click on AFR, it tells me the 75/20 rate history and what it is this month, what the short-term applicable federal rate is, long-term, mid-term applicable federal rate, and long-term. And I can use the lowest of this month, which is 4.15, last month 3.99, month before 3.94. So Joey, we have to ask Kevin why it's showing 4% when it should show 3.94%. Okay, so I close out of that, go back to my installment sale. What kind of note am I using? Am I using conventional or self-canceling? If I'm using self-canceling, I need to go to the self-canceling note calculator to determine a higher interest rate, and the note will cancel on death, and to determine how long the note should be. But for now, I'm going to use a conventional note, 20 years, 4% interest. And I'm going to have the grantor pay the income tax on the trust income. There will be no tax on the sale. And one of the assets the grantor has throws off income at $500,000 a year. It's an S corporation, so I'm going to keep track of that here. And that $500,000 a year going to the installment sale calculator is going to reduce the income of the client up here. So he's making 300, but when he shifts 500, or he's saving 300,000 a year now, but when he shifts 500 to the installment sale calculator, this will be treated as if it was negative $200,000 a year. It's complicated, but life is complicated. We want to show the right numbers for these clients. Now, will the note be discounted on death? Yes, if I die owed a 20-year promissory note for 16 million, it's not worth 16 million. I'm not going to pay estate tax on 16 million. Let's just say I take a 10% discount. I'll pay estate tax on 90% of 16 million. And will I pay a guarantee fee? Well, the gifting, do I have a 10% seed capital gift? If not, do I want to get a guarantee of the note from the gift trust? And if so, will the guarantee fee be a flat $5,000, which will be paid from the installment sale trust to the gifting trust each year? Okay, so going back now to the regular size, before life insurance and installment sale, estate tax $4.8 million. After life insurance trust, estate tax $4.3 million. And then when I click on installment sale, estate tax goes from $4.3 million to 0. A good day. So that installment sale calculator, that installment sale took care of the estate tax completely. Now, let me go back and we will show the exploding asset. So I go to my assets, business assets. I go back to the exploding asset. Now, when I have the exploding asset and none of it's being transferred, when I go to the installment sale, now I still have a $5 million estate tax because I did not put the exploding asset into the installment sale arrangement. So now what I can do is I can say, well, what percentage of this do I need to put into the installment sale to zero it out, to zero out estate tax? And it says 30%. So now I put 30% of that exploding asset into as part of my installment sale, and it zeroes out the estate tax. But this is showing me, as you know, only the estate tax in year 20 or year 19. What happens if they die sooner or later? So I go to my timeline, I click on my timeline, and I see that if they die sooner, there is going to be, see, they die here. But if they die sooner, there's going to be an estate tax. And the reason is because all these years, they're going to pay income tax on the income of the installment sale trust and the gifting trust. And that's going to get their estate down. But if they die in the meantime, there's going to be an estate tax. Well, how much of the exploding asset do I need to put in here to zero out the estate tax? And I'll click up here. And as I click up, I see the estate tax coming down. If I put 100% of the installment sale of the exploding asset into the installment sale calculator, then after 2032, there will not be any estate tax. Now, this assumes that the estate tax exemption is not going to drop to half in 2026. I can go ahead and click here. If it drops to half in 2026, we're still in trouble. So there will be more that we will have to do, or the client will have to maybe buy some more life insurance to pay the estate tax. Or at this point, let me go down to logistics, and I could page back. I could kill spouse 2 off earlier to demonstrate the charitable. So I will move the date of death back to show now that there is estate tax after the installment sale. Go to testamentary charity and show the CLAT. So once I get my settings where I want them, I click on generate client letter. I can show all the scenarios. Now, when I click on generate client letter, there's going to be about a 1-minute pause. During the 1-minute pause, it's preparing the letter. You can go walk your cat, and the computer is going to talk and summarize the situation orally, but you're not going to be able to hear it. Only Joey and I are going to be able to hear it. But I'm going to go ahead and click this, and I'm not going to show the timelines, that just to save a little bit of time there. I'll click this. We'll go silent for about a minute, and then we'll be right back.
I am now preparing the letter for Bob Sample and Mary Sample. Their total investment assets are $33 million. Their residence is $4 million. If they do everything check, their estate tax comes to $1,600,690. If they want to do charitable, their estate tax can come to $0.
Okay, so it gave me a little summary of them. It gave me something to do while I was waiting. Now it's drafting the letter. You can see how far along it is with the letter. The letter comes out as a Word document that you can save onto your system and go ahead and customize. The letter only shows one set of scenarios. It doesn't show one set of scenarios with the exemption going to half at 2026 and the other going to half. So we end up giving a client like 3 different letters. This is the one showing these scenarios. This is a one slightly different scenario. This is the third one. Maybe in a year or so, we'll drastically improve that. But anyway, I go here and there's my letter. I open it up. It's a Word document. I click Enable Editing, and the document gives me the client's name, gives me the date we're doing this, shows me some of the basic information that was input. I'm able to add whatever notes I like there. Then it explains the estate tax system. It gives you all the inputs so that you can see your inputs manually there. And then it says, well, with no planning, here's the situation. If you both die late, and then here's some of the key numbers. If you do the credit shelter trust, here's the situation, and there's the key numbers. If you do the Cupert, there's the situation, and there's the key numbers. Now, I believe that by December 31st, it will also provide PowerPoints. So I think a lot of people will just want to see the letter as a PowerPoint that they can see send their client. So that is on our requisition list. And of course, the letter can just be forwarded to the client at the same time that you forward the settings, and it will include an instruction email to the client, which, Joey, we have to remember to draft. Dear client, I've done some estate planning for you. You can't rely on this, but it should be educational. I've shot a video using my GoToMeeting feature or my Zoom meeting. If you watch the video, it explains the estate plan. And then if you want to do it on your own, you can click here and open Estate View and use it on your own. And by the way, here's also a letter in Word and some PowerPoints. So that's where we are with the main Estate View module as we stand today. I do not expect it to change much between now and the end of the year. We will be improving it as we go along, probably adding different asset classes. We may make this into an EZ version and a more advanced version if we find that people are intimidated or confused by all of the choices. But I think it's worthwhile to spend an hour or 2 hours of a estate tax planner's time to learn how to use the software. If you're doing it on a real client matter, you will generate significant value for that client. Now, for those of you, and we still have about 150 of you on this, I will go ahead now back to the calculators just to reinforce a little bit about what Ed said on the Cupert. So, and plus some of you may be new to this, so you haven't seen anything about our calculators. So when you go to the calculator, the inputs are on the left. You can move it a little bit to the left and right. And then your primary summary for each Cupert is across the top. This one actually talks. When you click the speaker, it explains the Cupert to you. I won't do that because you won't be able to hear it because of the way GoToWebinar works. And then you get a year-by-year spreadsheet. So what I have here is a September 28, 2023 transfer of a home to a Cupert. The 75/20 rate is 5%. This is going to be a one-person Cupert. The person's 59 years old. I could make them 62 if you like. It's telling me their life expectancy is 21.4 years. We may want to do a 15-year Cupert. We're going to show them living until age 85, which is 23 years from now. And the home is worth $5 million. We think homes are going to go up in value by 4% a year. And then the estate and gift tax rate, 40%. Mortality table 2010 is the one you have to use. And we'll start off by giving 100% of the home to the Cupert. Once the term is over, once the 15-year term is over, the person will start paying rent. based on 8% of the value of the house each year for the rest of their life. So across the top, Cupert 1 is a 15-year Cupert for a 62-year-old. The life expectancy is 21.4 years. They're going to actually die in 23 years. We're going to illustrate 30 years. We'll show the time value of money after the 23. $5 million home, 100% transferred to a Cupert, no discount. $5 million value. So 74% chance that this person will live the 15 years. And the gift is only $1,789,000. So I'm only using $1,789,000 of the client's estate tax exemption. And if they sell the home during the 15-year term, they'll, instead of having rent-free use of the home, they'll be able to receive $340,000 a year for the rest of the 15-year term. So the spreadsheet is long. What I can do, if I hit fit full, you see the whole spreadsheet, but certainly not convenient at this size. So what about if I just show you every third year and the final year? Click here, 1, 2, click here to full width. So now you see that in year 15, they had a 71% chance of living that long. And the value of the home by now is $9 million. The rent, $723,000, and the estate tax savings, when you count 1 year of rent and the value of the home, the estate tax savings is $3,336,000 if they die in year 16. But if they make it to year by year 30, you're going to have a home of 20. You're going to have a home worth 15 million. I'm sorry, a home worth 16 million, plus the cash from the rent and from the growth on the rent is you're going to have a 29 million passing outside of the estate tax system. So that's Cupert 1. Now I want to do Cupert 2. I'll click duplicate. Has nothing to do with the game of bridge. And now Cupert 2 is exactly like Cupert 1, but I want to show the client that we could do a 10-year term, and they're more likely to live 10 years. And the estate tax savings, if we do a 10-year Cupert, is actually a little bit more because of the rent being paid and because of the smaller amount of exemption used. And then I'm going to do a third Cupert. So I'll click here, duplicate. Cupert 3 is going to be just like Cupert 2, except she's going to do 1 Cupert for her son and 1 Cupert for her daughter, 50% each, and we're going to take a 15% discount. So I'll click the discount to 15%. And now the estate tax savings is a little bit more. It's a little bit more by about $838,000. So that gives you a little bit of a view of how a calculator works. And if I want to export the spreadsheet, I click Export to Excel. Now the spreadsheet is an Excel document that opens right up for me, and I can use it and change things if I want to change things. By December 31st, we'll also have an income tax analysis to show what the detriment is if you're not going to get a new fair market value income tax basis if the person dies. Now I can go to general explanation here, and I can go ahead and do PowerPoints for all 3 Cuperts. I can do a general explanation, a short explanation, a planner's checklist, and a PowerPoint for all 3 Cuperts. I can put the client's name here, John Watch Me. Okay, click submit. Instantly, I have a short explanation of the numbers, and I have 3 PowerPoints. Now the PowerPoints are not where I want them yet, but they're not bad either. So here's a PowerPoint, and the PowerPoint, I can go ahead to slideshow from the beginning, and for some reason it didn't, but it's over there. Not sure how to move it. All right, so anyway, you'll be able to see the PowerPoint gives the information on the Cupert. It's a 10-year Cupert, value of the home, value of the gift, percentage chance of survival, and then what happens during the term, what happens after the term, and the handy dandy spreadsheet. So I have those PowerPoints for all three of the scenarios. I can review them, I can customize them, and then I can send them to the client. I also have the Cupert Planner's checklist, which needs a lot of work, but at least you can see it's working. So Joey, anything to, oh, I didn't cover the timelines and charts. Now I can also show these three Cuperts by what's the taxable value of the gift, what's the life expectancy situation, and if I toggle the term of the Cupert, you see the circles moving. Isn't that neat? So you see the blue part is the good stuff, it's out of your estate, but the yellow part is the taxable gift. So it can show you those differences. I can also show you the probability of this person dying by, at age 75, they have an 80% chance of being alive. And then I can show you the property value increase. And I can show you the rent and accumulated money inside Cupert 1, 2, and 3. And why the shorter Cupert was actually better if the client is going to pay the rent. And then here I can show the assets removed from the estate over time in Cupert 1, 2, and 3. So that is the Cupert calculator. Now all of these calculators have the same type of scenario. Here's the CLAT calculator. There's basic, and then below it tells you, if you click advanced, what these other things are. It gives you a summary. And one thing I like about the CLAT calculator, and I've always wanted to know this. So I do a 15-year CLAT, the client is 65. I'm going to show 18 years. They're going to get a tax deduction. And the annuity amount is $50,000 a year for 14 years. Final payment of in year 15 of $966 to charity. And then what's left for my descendants is $504,000. So the income tax savings, $244,000. The remainder interest for my children, $573,000. The charity gets $1,666,000. What are the present values of this? In other words, my kids get $573,000, but they don't get it until year 16. So the present value of that, assuming the growth rate that I've chosen, is the kids are only getting $181,000 worth of assets. And with the tax savings, we're ahead by $431,000. The charity's getting $1 million. So, you know, that's CLAT 1. Now, CLAT 2 is, let's use a longer term. Let's go 25 years. And if we go 25 years, we see that the remainder interest is $1.3 million to the descendants. The income tax savings is a little bit less, but the remainder interest of $597,000 to the children and the present interest to the charity of $603,000, that's where you go about 50-50. So based upon the assets growing at, based upon the the assets growing
It's like 6.1.
at 6.1%. Right, there we go. Now, if you think the assets are going to grow at 7%, click to 7%. Now the value of the remainder is bigger than the value of charity. But what the other thing you can do, and I'll call this clat number 2. So that's clat number 2. Now clat number 3, I go to advanced, and instead of putting 1 million of assets into the clat, I'm going to put 1 million of assets into an LLC and transfer the 99% LLC interest to the clat and take a 20% discount on the value of the LLC. Well, that's clat number 3. Now you see that what goes to the children is $2 million in year 20 in that year. So now the present value of the remainder interest for the children is $918,000. The present value to charity is $482,000. And again, I go to general explanation. I click all 3 clats. I click PowerPoint presentation. I click submit. And now I have 3 PowerPoints, 1 for each clat. I'm sure someday there will be 1 PowerPoint comparing all the clats, but that'll be another day or year. So Joey, I think I've probably worn out my welcome.
That's been great. And then I just want to mention for beginners, if you're not sure what to use, if Alan, you click go back here, back to that main dashboard screen. So if you just hit back again, you should get there. There's a nice sample plan on that screen that you can download, and then you can look at all the inputs we used there as just an example, and that'll help you get up and running with the state view and kind of understand what values kind of make sense, just as a rough estimate, to kind of learn the program.
Right, so that would be clicking sample plan here. And then when you click sample plan here, it's created a sample plan, which is on my computer. So there is the sample plan. And by the way, you saw that I wasn't able to go back, so I had to reopen it. But notwithstanding that I reopened it, it kept all my settings that we were just using. And that's nice, because if this thing shuts down or lightning strikes, whatever, when you reopen it, it's going to start you right back where you were until you go to File New. So I can go ahead and save what I had, and then I can go to File New, and now it starts me anew with our standard settings, which of course you can change. So, and eventually, Joey, I think we'll have every planner will be able to have their own sample, their own starting settings. But
Right.
we found that these work. All right. Well, for those 129 people who left their computers on and went to play golf, and then they're going to come back and watch this, I want to thank you for your patience, and I ask you, if you would, to give us any questions, comments, or suggestions. Obviously, we're spending a lot of time and even some money to make this product as good as it can be, to unleash estate tax planners to be able to run the numbers and see what these numbers say. Should you do a Cupert? How would a GRAT work? What would a CLAT look like? What are your choices? What are the financial implications of what choice? So thanks again. You can reach me, Gassman, Gassman, at gassmanpa.com. If you're going to the Heckerling Institute in January, which is the #1 conference for estate planners in the United States, you'll meet 3 million or more, 3,000 or more other estate planners. We will have a display table there. We will have an event. So let us know if you'd like to attend, and have a fantastic rest of your day. Thank you so much, Joey, for all the work you've done on this. Thanks to Ed Gordon for his brilliance today, and have a fantastic weekend if I didn't ruin it for you already. Thank you.
Thank you, everyone.